Let's have a look at the Labour Party's tax plans and how they might impact you as an individual and as an investor. Here is a composition of how the government raises its tax revenue. What's interesting to note is that the areas the Labour Party say will be untouched are actually the largest areas of tax revenue. And so where it does plan to make changes, it's either not going to raise very much money or it's going to have to make some pretty sweeping changes. The Labour Party say they won't increase income tax, but they could end up rebalancing that tax by introducing reductions for lower paid workers and then higher rates for higher paid workers. HMRC has a supercomputer called HMRC Connect that pulls in staggering amounts of information, billions of pieces of data on individuals, and it looks at data in their bank accounts, data from their stockbrokers, and now it's being extended to include data from things like Airbnb, eBay, Gumtree, Etsy, Vinted. So it'll have a lot of data automatically on you on what you're doing online. And then in addition to this, Labour plan to spend £855 million to increase the number of tax compliance officers by up to 5,000, so there can be a greater number of investigations into people not paying their fair share of taxes. As an example of the government snooping on you, eBay is now passing on data automatically to HMRC if you sell more than 30 items a year or if you have income through eBay exceeding £1,770. The outlook for the state pension is that both Labour and Conservatives are committed to the triple lock, which means that state pensions will grow by the minimum of earnings growth, inflation, or 2.5%. And in addition, the Conservatives plan to raise the personal allowance for pensioners so that those receiving a full state pension won't automatically become taxpayers. There's been talk of the Labour Party reintroducing the lifetime allowance, although there's been no mention of at what amount the lifetime allowance might kick in. There's also been talk of a broader wealth tax, which is essentially what the lifetime allowance becomes. Then there's also talk of cutting relief on pension contributions such that people can no longer get the 40% tax relief. That all of these are currently in discussion. So we've got a situation where inheritance tax suggests you should put money into a pension for retirement savings, but the lifetime allowance, if that's reintroduced, suggests you should put money into an ISA to potentially avoid confusing tax liabilities in retirement. The Labour Party want to make tech giants pay their fair share of tax, and there are already plans in place to do this under a scheme known as Pillar 1 from the OECD. This involves reallocating some of the tax payable to where customers are located rather than where the parent company appears to be based. Labour plan to introduce a proper windfall tax on energy giants, and there's currently an energy profits levy which puts a marginal tax rate of 75% on North Sea oil, gas and production that's set to remain in place until 2028. So it's possible this tax charge could go higher or remain in place for longer. We could possibly see increases in capital gains tax under a Labour government. Capital gains tax could become more closely aligned with income tax, and at the moment CGT is only 10% for a basic rate taxpayer or 18% if property is being disposed, and for a higher rate taxpayer it's 20% or 24% on property, and those amounts could easily be increased. One potential change under a Labour government is an increase in inheritance tax, which is currently 40% on assets over £325,000, but you can pass on your home to your partner. So a possible change would be to introduce a higher rate of inheritance tax on amounts of, say, over £1 million, or maybe to remove some of the exemptions for trusts where people put assets into a trust, ring-fence it and try and avoid tax, which isn't really fair on other people. One potential change under a Labour government is a tax on second homes. The Scottish Parliament has already approved powers to increase the amount of council tax payable on second homes by up to 100%, and this is known as double council tax. So, for example, from the 1st of April 2024, Edinburgh has put a double tax charge on second homes. The capital gains tax threshold is £3,000. So if you dispose of personal possessions of more than that, then you may need to pay capital gains tax. In addition, if you purchase stock, even if it's second-hand, with the intention to sell online, then this is trading. And if your gross turnover exceeds £1,000, then you may need to register for self-assessment as self-employed. Reducing tax thresholds can catch people out over time. For example, the dividend allowance has been lowered from £5,000 in 2018 down to just £500 today. So whereas previously you got a little bit of dividend income, you don't think you need to declare it, suddenly you can get caught out and the HMRC supercomputer can dob you in and make you pay tax. I saw this image online about where Labour thinks the extra money is going to come from to fund its spending. It's actually from an old manifesto, but I thought it could still apply today. It talks about corporation tax rises, although actually now that's unlikely. Income tax rises, where it was talking about 45p threshold, £80,000, and a 50p rate at £123,000, talks about raising stamp duty, talks about reversing cuts in capital gains tax and inheritance tax, talks about VAT on private school fees, and then also a really interesting thing is limiting tax avoidance and some of the powers that now exist to do that. So some implications are that if you're holding oil and gas companies or large multinational corporates, then a Labour government might not be that great for your investments. As an individual, you might find tax creep on dividends. You need to come clean on your side hustles. Your property investments might get taxed even more, and some tax avoidance schemes might come undone. I do believe that paying tax now to potentially have a lower tax bill in the future is not a good strategy, because it means that money leaves your pocket when it could be compounding on the stock market. So the best thing to do is to keep abreast of tax changes and react as and when they're introduced. If you're interested in calculating your tax bill and optimizing the tax that you pay, check out the video on the left. And if you're interested in planning for your retirement, check out the video on the right.